Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, and boy, did we have another wild week with the Dow up again over 400 points. You can see here on the Dow Jones Industrial Average ETF, ticker symbol DIA, we have a green candle on higher volume. However, the conflict is down below. You see that stochastic down there, it's starting to turn sideways. We call that a hinge. Now, it's already in an overbought condition. And so that's a sign of weakness. Now, you all know by now, or at least the regular viewers know by now, that my longer-term downside targets are represented here in this red dotted line. But as you will see towards the end of this video, as I highlight the trade of the week, 100% of our equity trades this year have been bullish. And that might sound like a conflict, but remember, and I have to keep repeating this because I could tell from some of the comments that people are just not hearing what I'm saying with regard to long-term outlooks versus short-term targets. My long-term outlook is extremely bearish. I'll show you some of the economic numbers that supports that bias to the downside. But we have to go with the momentum. And in the last couple of weeks, we talked about the 20-period moving average, crossover method for getting in and out of stocks. On Wednesday during the midweek report, we talked about MOBO bands. We'll talk a little bit more about that here today. And if you're an option trader, you'll also know that we have a mixed bag of bullish and bearish spreads that we keep for the long term. So again, my longer term downside target is 368.12. You could see that next week we have a shortened trading week. Even on Thursday, we have the day cut short at 1 p.m. and then we're off on Friday for the 4th of July celebration. But look to the left as I draw to the right. You see that high right here? That is a resistance high, but not only is that a high, it's a role reversal where former support turned to resistance. I talk about that quite a bit. And as I teach through repetition, because many of you know, again, that repetition is the best teacher, we have to keep an eye on the charts and look at the oscillators, and especially following my 7-point trading checklist puts the odds in your favor. Now, if you were on the beach and the storm clouds were rolling in and the lifeguard started blowing her whistle, as you see here in this image, you have the ability to get out of those waves, but then there's some risk takers out there that would rather just take their chances. Well, the charts are giving us the warning flag. It's totally up to you if you're going to take a long position and do nothing to protect yourself. But like I said before, 100% of our positions on the equity side have been on the long side, but we use trailing stops, and we also apply the 1% rule for managing risk. I'll get more into that towards the end. So while I do believe that we could see a little bit higher on Monday because of the increase in volume, this is going to be a resistance area right up here at around the 440 to 441 area. Now, looking at IWM, you're going to see a little bit different in that we do not have a big green candle. We have a spinning top, which is more of a bearish condition. It's a sign of indecision. And down below, you have a pivot forming on the stochastic with a slightly higher price high. See the slightly higher price high, but we have lower highs on the stochastic and much lower highs on the CCI. That's a negative divergence that I talk about quite often. Pay attention to that because it's very important when you're looking for signals or reversal points, also known as pivot points. Looking at the Qs, ticker symbol QQQ, you can see another spinning top. Not only do we have a pivot on the stochastic, but the CCI is now heading lower. We have a gap below the market. That's going to be my short-term price target. For the intermediate-term traders, that downside target would be filled right there at that high at 532.17. Again, my longer-term target for QQQ is down there 417.67. Looking at SPY, you can see something very similar. We've got a resistance point being reached right here. And you see the stochastic is starting to hinge. The CCI down below is starting to pivot. Those are negative signals. Again, you have a gap below the market. Remember, 80% of the time when it comes to equities or ETFs or even the major markets, 80% of the time, those gaps fill. On the VIX, it's a little bit different. 100% of those gaps fill. Let's talk about the VIX here for a moment. You can see that we have not only a small body candle, but that is an inverted hammer. I haven't talked about the inverted hammers in a while, but an inverted hammer is a small body with a long shadow on top of that candle at the end of a downward leg. Now, remember from, I guess it's a month and a half ago, I talked about the open gaps on the VIX. This green dotted line is an open gap. I gave 100% guarantee that that gap will fill. The big question is when. We never know when, but we do know from history, because the VIX is an oscillating index, that 100% of the gaps do fill. Now we have another gap down below here, but still above the market. That gap would be filled on the low from this red candle at 1982. So that is guaranteed to fill, and it certainly looks like we're starting to get that movement. This is a pivot, a slightly higher low, higher high. Now, I did think we would fill that gap by today. That wasn't the case, obviously, but I do think that next week there's a very good chance that that gap could fill. Now, remember, like I said before, for the most part, the VIX is inversely related to the S&P. So if it's expected to go up to fill this gap, the S&P is expected to drop, and it could also cause the gap on the S&P below the market to fill as well. Now, I want to talk a little bit about the economic data that's come out. If you look at the GDP, this is absolutely insane, and this is the confirmation that I look at to keep my long-term downside targets in place. The world stock market cap to global GDP, this is the ratio that many analysts look at. It recently hit 117. That is the second largest percentage ever. The value is even higher than the peak of the 2000 dot-com bubble. And this is absolutely incredible, because what we're seeing basically in the numbers is that the markets are extremely overvalued. But it seems that investors are completely ignoring the data. Another thing you have to pay attention to, because we talked about the bonds that are coming due and how we have to refinance the cost of carrying our debt, the Treasury market is experiencing a little bit of a hiccup here, actually more than a hiccup. China is dumping U.S. Treasuries, and they're buying gold at record levels. And this is one of the pillars of global finance, and it is crumbling. And you can see the white line is representing the Treasuries, right? And the gold, represented in this gold colored line, is still screaming for the highs. So you can obviously see here what's going on between U.S. Treasuries and gold. Now, one of the other reasons why I believe China is dumping the Treasuries is because not only China, but many other countries are not willing to hold our debt. And you can see that the dollar has now lost more than 10% of its value this year alone. And it's the worst first half in almost 40 years. Now, I want to point something out here, because the dollar, for the most part, since 2011, has been in a very well-defined channel. It's a trading range that's been sloping higher. But for any of you who study channels or even price patterns, you'll know that once a channel line is broken, and let's say it breaks to the downside, what you do is you take the width of the channel and you attach that to the breakout point, and then you draw another channel, and that's where the dollar will most likely find its next support level. Now, if you look to the left, the bottom of this so-called new channel would coincide very nicely with the lows from back here in 2011. Now, as the dollar drops, I'm just going to do a quick economic 101 lesson. As the dollar continues to lose value when compared to the other global currencies, the cost of exports for the U.S. consumers goes up. In other words, we lose buying power. So when you combine that with what's happening with the trade war, again, I'll talk about that in the next slide, you're going to see that there is inflation that's going to be coming back, whether you like it or not, whether Donald Trump believes that or not. We're going to see inflation, and it's happening right there as the devaluation of the dollar is taking its toll, again, on the cost of imported goods. So if you're out there buying anything from China, China is going to have to be paying a tariff on top of the loss of buying power in the US dollar. Now, on July 9th, the big showdown is coming with the trade war, and I think you're going to see a lot more of the news coming back into focus. Now, there's a lot of back and forth banter as to whether or not they're going to extend that deadline or even shorten it. But today we had Trump make a comment that he could extend or even shorten it, and the futures markets took a quick dump and then later recovered. But we're going to see volatility as the news unfolds with this trade war, especially between China and the US. Now, one of the things I want to point out, and I've been doing this quite regularly now for the past month, is I'm showing you the trade of the week. Well, here it is. The trade of the week went out on June 18th. And what we did is we bought ENPH. This is N phase. And we took a bullish position. And the trade price was $36.05. Now, as of yesterday, the stock closed at $43. Now, I want to stay on this slide just for a little bit. Remember, this is our report card and what we're doing for our members. So take this as educational content only. I have to say that, obviously, because YouTube will take us off the menu if we start giving advice here, and I'm not. I'm just trying to show people how to trade and how to manage risk. However, when we put a trade publication out such as this, I focus very intently on risk management. So when the publication went out, the stock was trading 36.05. The members who were trading this would have put their stop loss order at 34.05, right? They probably put it at 34. Many people don't even pay attention to the pennies anymore, but I'm just, again, for educational purpose here. So if the stock had gone down to 34.05, the trade would have been closed, the stock would have been stopped out, and the members would have lost 1% of their account because they're following the 1% rule. But again, I have to keep repeating this because I can tell by the comments that a lot of folks are just not hearing what I'm saying. Long term, now we're talking a year, 2 years, possibly 3 years. I'm extremely bearish on the market to the point where I think we're going to see a major collapse in the market. However, here's the actual trade card. And you can go back and look at the dates yourself on any chart. Starting from the beginning of the year, you can see that the first column here represents the date that the publications went out. The ticker symbol is in the next column. And here's where I want to draw your attention to right here. Every single one of these trades from the beginning of the year was a bullish position in that underlying stock or ETF. Here's the trade price. Here's the risk per share as we go ahead and manage our risk. And here's the outcome. And you can see here that out of all those trades, there were only 5 positions that were stopped out. Even the DJT was stopped out, but that was voluntarily. We didn't even let that stock go $2 against us. Negative news came out on that one. And after a small loss, we got out. And it was a good thing we did because the stock wound up going a lot lower. This position right here in AAL, which is American Airlines, is still open and has not been stopped out. It's pretty much trading where we got into that position. But here's the trade of the week right here, N phase. Again, 36.05 on June 18th. And as of yesterday, was trading 43. So that position, as of yesterday, was up 19.27. Now, you may have heard me say that when I'm announcing the trade of the week, this is more or less the hint to the members, the trade is basically done. There's no need to hold on to that because now the world knows about it. But look what happened on the 18th when the trade went out. That green candle right there was the day that the trade went out. Now, if you're following my trading checklist, and I hope many of you are, especially the folks that are kicking the tires with the 15-day free membership, we look at the candle, we look at volume, we look at divergences from the moving average, we look at gaps, we look at the oscillators. Let me take this one step at a time so we could recap what happened on the 18th. Bullish engulfing is obviously a bullish signal. So we're measuring buy signals versus sell signals. Second is that on the way down, after this gap here, we saw the big volume drop on that green candle. Remember last week, I talked about volume as a leading indicator. When the volume is dropping on the way down, that's telling us that the sellers are losing momentum. So that's taken as a bullish signal. We also had a wide divergence from that 20-period moving average. That's known as the snapback or the rubber band theory. That is bullish. Down below, what's happening? We had the oscillator was oversold right here. The CCI was already starting to pivot and moving towards this buy signal. So everything on the chart as of the 18th was bullish, 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 and there was absolutely no sell signals on that technical chart whatsoever. So what did we do? We bought the position at 36.05, and then we took the ride. Now, interestingly enough, after the buy signal took place here on the CCI, we saw another big green candle, and the volume is now increasing on the way up. Here's the other lesson. Remember, when volume is increasing on the way up, the buyers are motivated. Yesterday, what happened is we came very close to this gap fill, which is going to be resistance. And as of today, we have a drop in volume. So if any of the traders who did not take a profit yesterday held on to today, they would have most likely gotten out on the opening as the CCI started turning lower. Now, moving forward, you can see that the stock is right on the moving average. There's no need to take any new positions. I wouldn't even look at it until it shows some extreme buy signals right down the buy side on the trading checklist, but that is ENPH. Now, we have some really good news for you, because next Tuesday, what we're going to do in order to give people a little bit more time to absorb the midweek report, we're moving the midweek, which was normally on Wednesday, to Tuesday. And we're going to be calling that Technical Tuesday from StickyTrades. And then on Wednesday, we're going to be doing live YouTube broadcasts for a half hour after the close every Wednesday. That will also be simulcasted on X. And then on Thursday, for our members, we will be able to recap everything that we discussed during the course of the week and drive all that content home. Yesterday, when we did the equity analysis call, we did the follow through on the MOBO bands. And that is basically when we set up David Elliott's MOBO bands on the chart. You can see here that we have MOBO bands set up. If you want the layout for MOBO bands, you could contact us at StickyTrades, and we'll be very happy to send that over to you. We were talking about Nvidia on Wednesday, right? Look what happened here. You could see that the MOBO band had an up arrow way back here. You see that up arrow right there as it closed over the upper band. And we were talking about Nvidia continuing at the higher levels because of the momentum. Now, if you see on Monday, and this is just a shout out to anyone that's trading Nvidia, if you have that position and on Monday you see a drop in volume, that's going to be taken as a negative. So you have to make sure that you're protecting your profits, because you certainly don't want to turn a winner into a loser. How many of you members have heard me say that? And that's true. We run into a lot of people that are trying to squeeze out that extra penny, and then the trade starts going against them and they never get out to take that profit, and they wind up regretting that. So hopefully you'll be able to join us on Tuesday for Technical Tuesday report. Wednesday, if you hit the notification bell on the YouTube channel, you'll be notified when we're getting ready to go live at 4 p.m. Greg Montwell will be joining myself and Nod from Nod Live, and Anthony, who's the CEO of our company. We're going to get on, have a good powwow about the markets, individual stocks, what's happening economically as we get ready for a shortened holiday weekend next weekend for the 4th of July. Folks, thank you so much for subscribing and liking, and above all, commenting. That really helps the algorithm and it helps us grow the channel. So have a good weekend, and we'll talk to you next Tuesday. So long.